Welcome back. You're watching The Investing Edge coming to you from the city of joy, Kolkata. With me is Feroze Azeez. We've spoken a bit about mutual funds and investing, but it's time now to let our audience ask the questions. Yes, sir.
Comparison with RBI bonds and your mutual fund recommended by yourself.
Gold bonds.
Yeah.
Gold bonds or a mutual fund as an investment. Any mutual fund or gold mutual funds?
RBI gold bonds and the mutual fund recommended by yourself.
The answer lies in the objective. If you can create a portfolio with gold bonds and back test it for 25 years and front test it for 25 years and still make the 15%, then gold will have a place in my portfolio. Otherwise, if it is not helping me meet the objective, which it is not, because gold might have last 1 year. Of course, this question is coming today, not 2 years back, because gold in the last 1 year has given 26% return. Right? This exactly 1.5 years back, the question was Bitcoin kya karoon? Right? Because after the return happens, gold has been the worst asset class in terms of dollar performance. You will not even know it because in India it is rupee. If you just track if you Googled gold dollar price, last 100-year data, you will get it in minutes before we finish the show. You will see from 1979 to 2003, it gave negative return. In India, gold is a smart guy. He's wearing a rupee jacket. Dollar ki jacket पहन के आता है हमारे सामने. Rupee has depreciated is why gold looks pretty. Gold 40,000 रुपए क्यों पहुंचता है? क्योंकि ज़्यादातर काम रुपी ने कर दिया उसका. रुपी की वैल्यू depreciate होते होते गोल्ड की वैल्यू appreciate हो गई. गोल्ड ने कुछ नहीं किया. गोल्ड डॉलर टर्म में आज भी पीक पे नहीं है. Right? Today, gold is 20% lower than its peak ever. But in Indian rupee, it is at the peak. Why? Because of rupee depreciation. So, but if sir's question was, gold mutual funds खरीदूं या gold bond खरीदूं? Hands down gold bond. ETF, gold ETF या gold fund खरीदने के बदले you should buy a gold bond because उसमें आपको ब्याज भी मिलता है और tax free मिलता है. 7 साल hold कर लो, gold अगर 80,000 हो गया तो tax free मिलता है. Long term capital gains is exempt. Between gold funds and gold bond. If you asked me, should I buy mutual funds or gold bond? I will say none. You should buy a combination. That's exactly what I'm saying. People are comparing products. Strategy is nothing but a combination of products which are complementary in nature so that enhances the chance of meeting your objective. Right? So if you compare products, then you may not have them in the right proportions. So there is a theory called Markowitz theory, which helps you create portfolio from 1,000 products. So use the Markowitz theory. If your advisor has not used it, then you have to ask him why are you not using it? In wealth management, that's the only guy who won a Nobel Prize. Why aren't you not using it? So use Markowitz theory to create a portfolio. So you need a strategy as against product comparison.
First one, I wanted to ask you that these 8 funds which you have selected, what has been the churn in the last couple of years, 2 years, 4 years, 5 years, or have they been constant?
The churn has been very low. The churn has been very low because they have been bought using regression, which is futuristic. So if you ask me, maybe one change every year and a half out of the 8.
So it's fairly a stable model which you have chosen.
Yeah, because if I look at rear view mirror, the time I enter, it starts doing badly. So if I've looked at regression, which is, and I really think if you have hard-earned money, it takes on a flight, just read up something on that. It's one of the best predictive models. So what happens is you are a little futuristic, so it will be more stable, relatively. That's what I'd like to assume.
Then the other question which I had for you, I mean, you're free to answer it. If you
No, I'd love to answer it.
You were mentioning that in course of 10 years, we should be able to have an appreciation of our portfolio by 4 times.
Correct.
Now, you have been in this line for 16 years. So by how much has your portfolio grown in these 16 years?
If somebody would have just to the T followed my model portfolio, what would his return be? What would his risk be? Audited by one of the big fours. One guy said, I don't trust this big four. So I audited it by the second big four. I said, all the fours have audit kara lo. You appoint an auditor. Because, so 14.2% is the return for the last 5.5 years. 15 se chuk gaye. Last year, the return was about 10.9%, which was a good return for last year, which was definitely significantly lower But then when you take lower risk, when risk happens is when you realize you took lower risk. In last year, if I lost 20% of my clients' money, then I was just believing that I took lower risk. So that's one. So returns would be nothing short of 23-24%. One of my files which I started in the trust file, which I started in April 2016, has a 43% IRR with a 13.5% standard deviation.
So what I heard, and so far I discussed with my RM, so it's like a standard structure for everybody, right from the CEO to you to me to everybody, and that's what's trust. But my question, which I'm still pondering, is on such kind of a diverse kind of investor with diverse kind of a background, diverse kind of a profession, diverse kind of an age, should this
Portfolio
one
be set.
course work, or is there a need for differential treatment?
So firstly, you have to divide your money into two portions. One which I'm going to consume, the one which is generational. Whatever is generational has nothing to do with my age, my risk, right? If you have 100 rupees, you're going to only consume 30 rupees maximum. The 70 you are only the custodian of that 70. You're the person who earned it. You are the custodian, but you are not the consumer. The portfolio should be designed as per the consumer's risk appetite age. So firstly, I bifurcate the money, and then whatever is the generational money, okay, which is not going to be consumed, has two important things. What is the return you will make? What is the risk you will take? Now, if I kept the risk at 15, not at 8, then I have to check, sir, are you okay with 15? Are you okay with 15? But if I bring the risk to 7, 8, and most of us sitting here, if they measured their standard deviation, will come above double digit only. I have seen hundreds of portfolios. Most portfolios come more than double digit, 12, 13, 14. So the client can't crib about 8 if he is already at 12. No? So when you operate your portfolio on LCM, least common multiple, if you brought the risk so low that most of us are anyways taking higher risk than that, then you can't have the risk problem. There will be 2-3 people who will say, no, I want flamboyant return, not 15, I want 20, 25. I tell them, sir, you're not my client. 2-3%. I will address this 97, 98%. So when I say the same portfolio, it is only for generational long-term money, right? So to take care of your current needs, your next 10 years retirement corpus, which you're going to consume and live a lavish life, that this portfolio cannot address. This portfolio only addresses the long-term generational money, and that too only the same portfolio because we can mathematically see that the risk is lower than what we are anyways taking, right? And the return is 14-15%. 99% of our people are happy with 14-15. They don't want 17-18. They're happy with content people. And if some people who are not content, I genuinely say, sir, you have to go to somebody else. Once I do that, then I can do more finance and less sales and marketing.
Well, on that note, Feroze, thank you so much for advising all of our investors, and thank you, audience, for joining us for this episode. We'll wrap up then on Investing Edge for this week, but we'll see you again very, very soon. Stay tuned to CNBC-TV18.